Following our process, we had taken the income statement balance sheet and we converted it into the first two economic statements, the TII, which is the reconverted income statement, and the TFI, which is the converted balance sheet. Now, it doesn't matter which one we did first. I said you can do them, they're independent, but picking up where we are now, to get to the statement number 3, which is the cash flow statement, or specifically CFI, cash flow available to investors, you would have had to do those two statements first. So once you've done those two statements, then you can do statement number 3. The CFI, which is the statement we're going to start on today, has 4 sections, just like the other 2 statements: operating, non-operating, debt, equity, 1, 2, 3, 4. And in every section, the process is going to be the same, which is we're going to take the cash from the income statement minus the change in cash in the balance sheet. And we're going to do that for operating activities, and that's going to be called free cash flow. We're going to do that for non-operating activities, the non-operating cash flows. We're going to add those two together, and that's going to be the CFI. Then we're going to look at the other side of the balance sheet. We're going to look at, on the other side of the income statement, the debt. So cash from the income statement, the debt interest expense minus the change in debt. And then we're going to look at the equity, which is the dividends, and the change in the equity. That's going to give us the other side of CFI, the funds flow side, which is going to match the cash that we have available to investors. And we're going to get them to balance. So that's the process that we're about to go through. Now, here's the other important thing. If I gave you 3 years worth of income statements and balance sheets, how many years of cash flow can you do? All right, somebody's holding up 2. So 2 is the correct answer. Why is 2 the correct answer?
Because you need to take into account the change from year to year, so there's only 2 changes.
That's right. So even though you could do 3 TFIs, 3 balance sheet rearranges, because it's change in the balance sheet, you could only do 2 years worth of cash flow. Because cash flow is all about the change in the balance sheet. So 3 years of TII, 3 years of TFI, 2 years of CFI. Okay, so that's going to be key. So in this simple example in the book, where they gave us 2 balance sheets and 1 income statement, we're actually just going to do 1 year of CFI because we only had 2 balance sheets. Okay, and then therefore the current year's income statement. So let's start out with the model where we left off in the video. So what we're going to do is we're going to add another tab, and I'm going to call this CFI, cash flow available to investors. Make it a little bit bigger so it's easier to see. Relative references, so I'll copy over the years. And paste those out. Now, here's what we're going to do next. Following the process in the book, the operating cash flows are called free cash flows, and the definition of free cash flow is gross cash flow minus gross investment. So gross cash flow is specifically defined as no plat plus depreciation. So off of the income statement, TII, rearranged, we have our no plat. And that's the operating cash flow. And then we add in our depreciation. Now, because I'm going to add in the depreciation, I'm going to change this sign to a positive 20, and that's going to get us something called gross cash flow, which equals the 210 plus the 20. So this company is generating $230 or $230 million, however you want to think about that, of gross cash flow selling products to its customers, right? Now, we talked about free cash flow as profit after reinvestment. So then the next piece is, what is the investment? What's the reinvestment in the operating capital of the business? Well, the shortcut formula for that is called gross investment. And the shortcut formula is the change in invested capital. So current year PP&E minus last year PP&E plus current year depreciation. That's the actual shortcut formula for gross investment. So what I'm going to do is I'm going to take current year's PP&E off the TFI. Sorry, scratch that. Current year invested capital minus last year invested capital plus current year depreciation, not PP&E. So current year invested capital minus last year's invested capital off the TFI. Current year invested capital is 425, last year's 375, plus current year depreciation of 20, basically says gross investment is 70, which means free cash flow, so I'll move this formula over here, it's operating, free cash flow equals gross cash flow minus gross investment. And that would be a correct answer. Okay? Now, here's the thing. I can also look at what's in gross investment on a more granular level. And specifically, gross investment is the change in the operating invested capital, which is on the TFI. Now, here's where I'm going to change things a little bit versus what we did on Monday. The whole point of doing this, and again, what the second part of the exam and the rest of the semester is about, is not just can you actually learn the structure of the formulas, but you actually know what you're doing. And the whole point of what we're trying to do here with gross investment is we're trying to estimate how much cash the company's going to have to reinvest to sell its products and services. Well, that's really what operating invested capital forecasts in the futures are about. That's the gross investment. However, more granularly, what we're going to do is we're going to say that working capital and long-term capital, PP&E, are going to go up at different rates. Right? So if we just forecast invested capital, we're assuming that working capital goes up at the same rate as net PP&E. But for most companies, that's not necessarily the case. So what we're going to do is we're going to eventually forecast the growth of working capital separately than the growth of PP&E, capital expenditures. So what I'm going to do with my operating invested capital is I'm going to move this down, and then I'm going to create the concept, or actually I already did this in the previous class, of operating working capital. Right? So operating working capital is inventory less accounts payable equals operating working capital plus long-term invested capital equals operating invested capital. Right? So what I did versus Monday is I rearranged the operating invested capital to put the current assets and current liabilities together, and I called that working capital. And then the other long-term stuff, I would net any long-term assets minus long-term liabilities, add them together, and that would be my operating invested capital. Right? That's what I had done here. All right, questions about that? All right, so here's what I'm really looking at is, first of all, operating working capital is not the same as what you've been taught in previous classes working capital is. So that's a good example of why if you use Investopedia on the midterm, you'll probably end up failing the midterm, and it's too late to drop the class, and you'll be begging me to let you out of the class, and I won't be able to do anything because my hands are tied. So it's kind of like that, DirecTV commercial, don't be Rob Lowe. So the idea is, here's why you can't use Investopedia. Our definition of current assets is operating current assets, which excludes non-operating current assets, such as excess cash. And our definition of current liabilities excludes anything that's debt. So current portion of long-term debt and short-term debt are threes. They're debt. They're not current liabilities. So we are going to rearrange the current assets and current liabilities to just be the operating current assets and operating current liabilities. So you can't just use current assets minus current liabilities. And that's what we've done here, but it's going to be more important when you do your homework assignment in the midterm. So back to this. Operating working capital is 75, PP&E 300 and 350. Add the two together. Operating working capital plus PP&E equals operating invested capital. So let's look at the granularity. Change in working capital is what we really care about. Well, the change in working capital is it went from 75 to 75 is 0. There's no change in working capital. No impact on cash. And if we go back to the TFI, we can see that. The company added 25 more of inventory, spent 25 in cash. The company didn't pay for it. Accounts payable went up by 25. So makes sense, 25 and 25 offset each other. There was no impact of cash on the working capital. PP&E. Capital expenditures is really what we care about, also known as CapEx. Now, again, we're actually going to use a solve for definition of capital expenditures in this class rather than use the capital expenditures that's reported by the accountants. All right, and I know I have a lot of finance and accounting majors in the class, so here's how you accountants are doing a disservice to us. Because what's now happening, and we've seen more of this in the last decade, is accountants are going into the balance sheet and they're making adjustments to the balance sheet that no longer hit the income statement. And that's a problem. All right, and you're using this fourth statement, this kind of change in equity statement, to basically make the adjustments to the balance sheet. All right, so they're not flowing through the income statement. And you're using this catch-all called AOCI for a lot of these adjustments. And what is AOCI? It's like adjusted other comprehensive income, whatever it is. What's the A? Accumulated. Whatever it is, it's like this black box of adjustments that you're making to the balance sheet that often do not hit the income statement. And that causes us problems because what you'll do is you'll take assets and you'll write them off, but they won't actually show up as write-offs on the income statement. And so the problem when you do it this way is you'll list the capital expenditures, but then you got to figure out what the adjustments that were made to the assets, and you got to net that out to get your cash flow to balance. Well, that's complicated. So here's how we're going to do simple. We're also going to take method B, which is we're going to solve for what the CapEx had to be given the balance sheets that are presented. So that formula says, sort of, simple accounting 101, is if we take our starting PPE plus CapEx minus depreciation, that should get us our ending PPE. So to solve for CapEx, we take our ending PPE minus our starting PPE plus depreciation. Put that formula over here. So, equals for capital expenditures. Ending PP&E minus beginning PP&E plus depreciation, 70. CapEx, 70, 230 minus the 70, 160. That, by the way, is how I got change in invested capital plus depreciation, because it's the solve for capital expenditure. That's just when you add it together, it's the change in the invested capital plus the depreciation. That's how I can get you the shortcut. Right? So I'm also just showing you the granular way to get to the shortcut. Right? Does that make sense? Questions? Okay, so that gets us something called free cash flow, which again is the cash that we could pay out to investors based on what we generate from operating activities, 160. Now we want to go through a similar process for the non-operating activities, which is any cash from the income statement from the non-operating activities, TII. So equals, and in this case, it would be the after-tax impact. So the after-tax non-operating income, which would be my non-operating cash flow for the income statement. Then I would look at the change in the balance sheet. So do I have any twos in the balance sheet? I have equity investments. So change in equity investments. Well, my change in equity investments is 25 minus 15. It went up by 10. And what I'm trying to solve for is CFI, which stands for cash flow available to investors. So the CFI is literally the cash flow that I can pay out to investors. Now, as you first start to convert these statements, here's where you're going to start having some trouble. It's going to be with the signs. So when I gave this exercise, your homework assignment that you're about to do, last semester, I asked people how long it took them, and a lot of people said it took them 5 hours. And I said, gee, that seems like a long time. And 4 of the hours were spent trying to get the cash flow statement to balance. And I asked, why did it take you 5 hours? And I think the exercise they went through is they were just randomly changing signs across all the items until the balance sheet or until the CFI actually balanced. And that's not the way to get a right answer. Because first of all, in your midterm, you just won't have that amount of time. So what you really have to do when you create this statement is you have to think about what you're doing. All right? And so here's what I mean. Cash flow available to investors is literally just that. It's how much cash that I have generated that I can pay out to my investors. All right? So let's think about free cash flow. 160 million, 160 of free cash flow. Can I pay that out to my investors? Yes, that is the theoretical payout rate. So that's part of my CFI. I generate $3 million of after-tax non-operating profits. Does that add to my CFI or take away? It adds to the cash that I can pay out to my investors. So 163. I spend $10 million buying a stake in another business, increasing my equity investments. Does that add to what I can pay out or subtract? So if I'm going to sum these up, I would actually have to flip the sign. Now, a little bit of an inconsistency, and the book is also not completely consistent, but the idea is free cash flow's definition is gross cash flow minus gross investment equals free cash flow. CFI is free cash flow plus the non-operating cash flows. Now, I'm just going to use in Excel the at sum to add these three things together. I could have added these two and subtracted the positive 10, and it doesn't really matter to me how you set it up as long as you understand the directionality of the cash flow and understand why you're getting the 153 for the CFI. So the key to the 153 is that is the cash that we have available to pay out because we generated 160 million from operating activities. We generated 3 from non-operating activities, and then we spent 10 more to buy more non-operating assets. So we basically had 153 available to pay out. That's what I need you to understand. And that's what I'm saying. As you're adding items to the CFI, thinking about the directional impact of that item on CFI will help you answer the question of should this be a positive or a negative number. If it's adding to what I can pay out, it's a positive number. If it's taking away from what I can pay out, it's a negative number. It's reducing my CFI. Does that make sense? So what you could have done is you could have said, following that logic, gross investment is negative 70, and I'm going to add the negative 70 to the positive 230 and gotten the same answer. I don't really care which convention you use so long as you understand that that was the point. 70 is an outflow, and therefore it's reducing the amount of free cash flow that I have for my business. So a hand. Question? Yes?
How did you get the negative 10 and change in equity investment?
So change in equity investments went from 15 to 25. There's a $10 change in equity investments. I just did the 25 minus the 15. And then I asked myself, should this be a positive or negative 10? And what I said is, if I increase my equity investments, it reduces $10 of the cash flow that I have available to pay out.
All right, that makes sense.
Right? Now, we're about to cross a chasm here. Because now that we figured out the CFI, we have to do the second half of the statement, called the financing or funds flow, and it's got a balance. So I know that that number at the other side also has to be 153. And if it's not 153, then I made a mistake. Now, here's the thing. It has to be positive 153 to balance. It's not about absolute values. It's about positive numbers. Now, here's the idea. And this is what's different than accounting. So forget your accounting. It's not a GAAP statement. These are economic statements. In the TII, total income available to investors, we said that that statement also works the same way as the CFI. If I generated positive cash flow, then when I pay it out to my investor, it's also going to be a positive number. Okay? The cash flow CFI works the same way. So eventually, my payouts are going to be positive numbers because I'm reconciling that I have 153 of cash to pay out, and I want to see how it's distributed. So because I have cash to pay out, the distributions are positive numbers because I need the two to reconcile to be the same number. If my CFI were negative, that means I would have to borrow money. Borrowed money is a negative number on the other side of the statement. Right? And that's just the nature of the statement because what we're solving to is the cash flow available to investors. When it's positive, we have money to pay out. Distributions are positive. When it's negative, we have to go find the money. Inflows are negative numbers. So, same process as the other side of the statement, income statement minus change in the balance sheet. off the income statement on the funds flow, the first item on TII, my 3, after tax, is the interest expense. Should this be a positive or a negative 15 based on what we just said? On this statement, at this time. Positive 15, negative 15. Should be positive 15 because it's actually paying interest to the bondholders or to the banks, and that's an outflow because I have cash that's available to pay to them. So it's actually a positive 15. All right, that's the only 3 off my TII. Now I look to the balance sheet. My 3 there is going to be debt. So again, balance sheet's all about the change. So I look at my change in debt. Debt went from 225 to 200. So debt went down by 25. On this statement, should that be a positive 25 or a negative 25? Should actually be a positive 25. So if I'm paying my bondholders or banks, I'm paying principal $25 million or $25. That's a payout, a distribution to them. So it needs to be a positive number. And what I'm telling you is when you start setting up this process, this is where it will start breaking down on your homework assignment. Because you'll get to the statement and you'll be like, should this be a positive or a negative number? Right? Because you're initially doing the delta. And then, as I said, you can just put all the numbers on here and keep randomly changing and hopefully it eventually balances. But that's not the point. The point is, as you're adding the item to the statement, just think about the directionality of the cash flow, and that will give you a hint as to what the number should be, a positive or a negative number. Payouts on this side of the statement are positive number. Cash generated on the other side of the statement are positive numbers. On the other side of the statement, cash used is a negative number. On this side of the statement, that means I had to go find that money. Cash inflows are negative numbers. That's how we're syncing this up. All right. Now, here's where the tricks start to come in on this statement that actually makes this a more convoluted statement. So like I said, on your homework assignment, on your midterm, I think you'll actually get through the TII and TFI relatively easily. This is the statement you're going to struggle with, and here's another reason why you're going to struggle with the statement. If I go back to the PowerPoint, when McKinsey in the book showed you these examples, the balance sheet on the left became the statement of TFI on the right. The income statement on the left became the TII on the right. This example of the CFI that we're going through right now, they have a GAAP cash flow statement on the left. They have a CFI on the right. You cannot get to the statement on the right from the statement on the left. With the first 2 statements, you can. You can directly rearrange the income statement and the balance sheet to get to their converted economic statements. With the CFI, you could not take a GAAP cash flow statement and get a statement of CFI. Now, why'd they put this in the book? I think one of the reasons was metaphorically. They just wanted to say that the GAAP cash flow is kind of a proxy for the type of statement that you're going to create for the CFI. But also, there's another reason, which is there's 2 pieces of data, generally, that are on the cash flow statement that don't exist on the income statement that we need for the cash flow statement. One of those is depreciation. Typically, on most income statements, companies do not break out depreciation separately. They bury it in cost of goods sold. So we actually have to go to the statement of cash flows to figure out what the depreciation is. The second item is the dividends. Okay? Dividends are not on the income statement. Dividends are on the cash flow statement. Income statement ends with net income. That's why TII ends with net income. But here's the point. Cash flow. This company paid out $113 million worth of dividends. This company generated $198 million worth of net income. Which number do you think we want to use for the equity cash flow? For this statement, yeah.
The dividends?
Why do we want to use the dividends? That's right.
It's going to the shareholders?
Because if we make 198 of net income, is that the money that we're actually distributing to the investor? No. What we're actually distributing, as he just said, was the dividend. So that's one of the quirks of the CFI statement, is we don't, even though we used net income to convert the TII, because we had to have a balancing statement, we get to the cash flow. The net income isn't the actual cash flow that's paid to the investor. It's the dividends. So dividends. Is this 113 of dividends on this statement a positive or a negative number on the CFI? It's got to be a positive number. So I'd actually put this as an assumption at the bottom of the first page. Dividends of 113. Positive 113, because it's a payout. Questions? Yes.
So the change in that is positive because you paid out 25.
Correct. Yes.
If a company doesn't pay dividends, we just
Zero.
keep it out of it. Or?
Yeah, so let's say the company had 198 of profit but zero dividends. On this statement, zero for the dividends. And so there's no equity cash flow that's actually going to the shareholder. The company's retaining the money. Right? And by the way, where that would show up is a non-operating asset called an excess cash. Okay. All right. Finishing up, change in the balance sheet. We have two balance sheet items that are fours. Common stock retained earnings. So change in common stock equals 50 minus 50. There was no change. So that one was easy. But let's say there was a change. Let's say the company issued more common stock, went from 50 to 60. On this statement, positive or negative? It would be a negative number. Let's say the company issued treasury stock. They bought back stock, which is a contra account to equity. Buying back shares, positive or negative number? Be a positive number on the statement, just like a dividend. Okay? Let me move this back just so I can get back to the balancing statement. All right, change in retained earnings. That's the equity for the firm. Went from 115 to 200, it went up by 85. On this statement, a positive or a negative number? Negative, because we have more equity in the firm. Those were the fours on the balance sheet, so now I can sum these items up, and I should get the same 153 that I got on the other side of the statement. So my statement balances. Yes?
Change in retained earnings is negative because it's in retained earnings and not paid out.
Well, yeah, exactly. I'm increasing my equity. That's why it would be a negative account number. All right? This is why I want you to balance statements, by the way. Does this statement balance? No. So I made a mistake. What's my mistake?
$85.
85 is what it's off by. So that should give you a clue. What's my mistake?
Is your retained earnings supposed to be positive?
Well, what if I made this positive 85? It's not supposed to be there at all. We're on to something. Why is retained earnings not supposed to be there at all? It's not that we've already accounted for it. Yep.
This is not a flow.
It's not a cash flow. It's a change in a non-cash account. Retained earnings is a plug. It's a change in a plug. And so therefore, just like net income, it's not a cash flow. So that's where we start to run into trouble. When we have balance sheet items that are non-cash accounts, and we see non-cash accounts change, we can't put them on the CFI. And retained earnings is an example of a non-cash account. So therefore, it's not on our CFI, and when we remove it, we now have a balancing statement. That's the other thing that you could struggle with. So as I said, the more common ones that you're going to get on your homework and that you're going to get on the midterm are number one, dividends, not net income, and number two, Retained earnings is not actually going to be on the CFI, and if you try and put it on there, there is nothing that you'll be able to do to balance your statements. And that's where you'll get frustrated. Okay? Anyways, we now have a balancing CFI. So, what does the CFI really tell us about the business? Again, this business generated 153 of cash to pay out. 160 came from free cash flow, running its business. It then essentially net invested 7 in non-operating activities, primarily to fund the purchase of another joint venture or some other business it doesn't run. It had 153 to distribute, gave 15 in interest, 25 to pay off principal, paid 113 in dividends, didn't buy back any shares, didn't issue any shares. That's what it actually did with the money. So that's the point. Here's the story of this company. This is a very important statement because it really tells you the story about the company. It really tells you what's going on with their business. This is what I mean by the clean analytics that come out of this conversion. So part A of your midterm, can you give me the CFIs? Part B of the midterm, can you tell me what the CFIs are telling you about the company? That's how we're going to start to distinguish. The second half of the semester, that's what's more important, is what stories, because finance is about storytelling, right? If you basically go to Crotonville and work for GE, one of the things that Jack Welch started a long time at Crotonville is he'll talk about margin walks. They'll make you take a walk through the financial statements. And literally, it is storytelling. It's how do you tell a story of what's happening with the business that the financials is giving you. And that's what we're going to have to learn how to do this semester. So, yes.
Can I see the formulas on the left side or the right side?
Which formulas?
The one for
These?
CapEx.
Yeah, I'm going to actually post this later today. So it'll be available, but those are the formulas. All right, final economic statement. It's called economic profit. So we will need another statement called EP, or economic profit. Stern Stewart calls this EVA, economic value added, but we can't call it economic value added because they've trademarked it and they want money every time people use it. So the rest of the world calls it economic profit. Okay? And again, the book defines it, but basically, what is economic profit? Well, let's set up our statement. So again, I can cover the 2 years. There's 2 ways to calculate it, primarily. The first method is more the direct method, which says we take our NOPLAT, so I can get that off of my TII. And we subtract what's called the capital charge. Now, what is a capital charge? Well, the capital charge equals the invested capital times the cost of the capital. So here's the idea. An assumption that I will give you is I'll give you a cost of capital for the company. And for this company, I just chose 10%. Just keep the math simple. All right? It'll be a different number on your exam. But basically, let's say it's 10%. So here's the idea. How much invested capital, operating invested capital, do I have in the business each year? And what is my WACC? It's 10%. So what is my capital charge? Equals 10% of 375, 10% of 425. That is called capital charge. This is the opportunity cost of capital. So that's the point. If I tie up $375 million worth of capital and my investors expect me to make a 10% rate of return, 10% of 375 means I need to make $37.5 million worth of profits. That is economic break even. It's not accounting break even, it's economic break even. I don't create value. I don't give you more than you expect, NPV positive, unless I make more than 37.5. So economic profit tells me whether or not I'm meeting for a current period of time the investor's expectation. But it's a 1 period change in value look at a business. Right? Now, when we do valuation, what we're going to do is we're going to forecast economic profits in the future, and that'll give us the forecast of the change in value of the business over time. We're going to add that to the starting capital, and that's the valuation of the business. That's method 2 of valuation based on last week's readings. So here's the other nuance. The only way the DCF and the economic profit valuations exactly equal each other in theory is if you use something called beginning of year invested capital. If you use average invested capital or end of year invested capital, you get close. But if you use beginning of year invested capital, you get exact. So we're going to use beginning of year just so I can show you mathematically the equivalence of the two on your exams and later this semester. So the way you'll see this is it's going to be called a boy capital charge, which will stand for BOY is beginning of year, right? And beginning of year is basically this number, the 37.5. So beginning of year is really the end of the previous year, so it's going to be the 37.5. That's my year 2. So I'll get rid of this. That's my year 2 capital charge, which is my end of year 1 becomes my beginning of year 2. So my economic profit equals my no-plat minus my capital charge, 172.5. I made 210. I was expected to make 37.5. I did 172.5 better than was expected. I created value during this period of time. Theoretically, my share price should go up. Questions? Method 2, yeah.
Wait, when you say that you did that much better, like that's better than like the industry average?
Better than what is expected to me for this amount of risk based on what I earn for this amount of risk somewhere else. Opportunity cost of capital.
Okay.
Okay. So let's go back. Method 2. Method 2 is called the spread method. Spread equals beginning of year, spread equals ROIC minus the WACC. And then what I do is I take economic profit equals spread times BOYIC. Okay, so what is my ROIC? And this is key. I'll use my beginning of year ROIC. So what is my ROIC? It's my no-plat divided by last year's invested capital. 56%. Right? What is my WACC? 10%. What is my spread? 46%. What is my economic profit? 46% of 375, 172.5. 2 ways, get the same answer. In this class, for all 4 statements, the first 3 you got to balance out. The 4th statement you got to show me you can get the same answer with both methods. If you work for a bank and you're a young employee and you give an incorrect answer to your boss and you make your bank look bad, it is career destroying. So I'm going to start teaching you how to foot numbers, because the same thing is it's going to be grade destroying for you. Is that, as I said, in this class, you can't just be lucky, you got to be good, which means you got to show me that it is the right answer. And one way that I'm more likely to believe it's the right answer is if you do it both ways. Because if you come up with the same answer both ways, you're less likely to have made a mistake. I'm not saying there's not a small possibility that you could make a mistake, but it decreases it dramatically. And that's just good practice, particularly earlier in your careers. Yes?
What was the formula for the beginning of your ROIC?
So basically, beginning of your ROIC is current year no plat, previous year's invested capital. I'm going to post this along with the video, this file with all the references online as well. So you'll have that available to you. So, part 2 of the midterm. Did this company create value? This hypothetical company. Yes.
Yes.
Why?
Because economic profit is positive.
Yeah.
So there's value.
What's another way of saying the same thing? So one way of saying it is this company has a positive spread on the economic profit side. Yeah.
ROIC is greater than WACC.
ROIC is greater than WACC. Either way gives me that same answer. Right? But this company created value. Right? So, this is what I mean by understanding the analytics of a business. Now let me come over here to CFI. Did this company generate more cash than it spends? Yes? Free cash flow positive. Right? And therefore, this is how it distributed it. Right? So, I don't know if this is still online, so I'm just going to guess. But this morning, I saw an article on the USA Today that talked about, not Starbucks, in the money section, Royal Caribbean Cruise Lines building a bunch of ships. Let's see if it's still on here. Let me just do a quick. Oh, here it is. 12 big companies bet on the future 6 hours ago. Now, they're not using the same definition of free cash flow. I mean, it's the USA Today. But what the guy that wrote this story said was they were looking at the S&P 500 and they found 12 companies that spent a high percentage of their revenue on CapEx. Okay. Now, as I said, as a professional, I'd be more concerned about the free cash flow than the percentage of revenue I'm spending on CapEx. But I think he's trying to get at the same idea. If you spend a lot on CapEx, you may actually have some negative free cash flows. Right? And that was the case with Royal Caribbean. And he said right now in the S&P 500, Royal Caribbean is spending a lot on capital expenditures, building ships like this with the rotating arm. And they've been doing this before. I previously made the idea. So here's the thing. If I tell you that the investment rate of Royal Caribbean is over 100%, what should that mean to you? That they're borrowing money, but why are they borrowing money if their investment rate's over 100%? Because they have what? Mechanically. Investment rate is gross investment divided by gross cash flow. What is this company's investment rate? Equals 70 divided by 230. What is its payout rate? Theoretical payout rate. That's the point. What if this number is above 100%? What if this number is like 150%? Then what's going to happen here? That's going to have to be negative. Does everybody see that? This would have to be negative 50%, which means this company's going to have negative free cash flow. So here's a question that I asked in the midterm exam a couple years ago that a lot of people missed last 2 years, which is if a company has negative free cash flow, do they have to borrow money? it would tell you that they would need to get the money from someplace else. So here's the other caveat. What if they didn't have a lot of cash to begin with? So Royal Caribbean doesn't have a lot of cash to begin with. It's spending huge billions of dollars building these new big ships. They have negative free cash flow. I know just by reading this article that they have negative free cash flow. I know that he's inferring that they have a investment rate of about 100%, above 100%. So what should I also know about Royal Caribbean? That they're borrowing money. So I should already know to look on their balance sheet to see if that's debt or equity and to see whether it's debt or equity that's going up. But I would know that I would see that by looking at this statement. How much would be quantified in the statement, but directionally I should understand that. Now here's the interesting thing. His argument is that Royal Caribbean share price recently has actually gone up dramatically, about 50%, as they've had negative free cash flows and investments over 150%. Why? What's different this time around versus when Royal Caribbean did this 5 years ago? Why is their stock price going up, where before, when they did this huge investment, their stock price actually went down historically? Negative free cash flow. Over 100% reinvestment. I got no money to pay out to my investors. I have to borrow it. Yet my share price is going up. What's the assumption that the investors are making? Mechanically. Yeah.
Future cash flows are going to increase.
Okay. Future cash flows are going to increase. Let's go back to the key value driver formula. What's the other key piece of the key value driver formula? I'm sorry? That they have to believe that the positive spread of the future, which is why that the future cash flows are going to increase, because that's the point. My future cash flows could actually increase, but what matters is that they have to increase fast enough to overcome the extra investment I'm making. And so therefore, I got to have eventual positive spread, which means positive free cash flow in the future, because ROIC is my proxy for my free cash flow. That's how these concepts are already working their way out. So I'm just telling you that I can look at the stock chart for Royal Caribbean. I can look at the fact that the guy's basically saying they're the biggest investor of CapEx in the S&P 500, know that they have negative free cash flow, know they're borrowing money, and know that the investors are backing them, thinking that these ships are going to pay off in the future because the feedback is the higher stock price. Otherwise, why is that stock price higher? Those are the dots that you need to start connecting between the financials and the actual performance of companies in the marketplace. And what I'm just telling you is you can read an article like this without knowing the CFI, and then within a month, you should be able to work backwards and start to almost picture what that CFI should look like without actually having seen the CFI. It's the story of the business. The flip side is if I give you a CFI and I didn't tell you anything about the company, you should tell me what the company should start to look like. Right? So that's going to be the other part of Part B of your midterm exam. So here's an example of this. So in Excel, here is a company called PVH, Philip Van Heusen. We talked about them a few weeks ago. This is Tommy Hilfiger, Calvin Klein, primarily as their brands. I posted this Excel file to Canvas in the file section if you wanted to quickly pop it up and see this exact same file. It's hard to read on the screen. Make the lights a little bit dimmer so it's easier to see as well what I'm pointing at. Now, this is something you're going to do after the midterm because you're going to actually take CFIs and you're going to create them for actual companies. Okay? So this is where we're going. Now, before we do this, there's one other thing I'll probably show you, which is you're going to do your homework assignment, and then there'll be a practice midterm that you'll do next week, and then your actual midterm. And by the way, the practice midterm I'm going to give you was actually the midterm from 2 semesters ago. So this is representative of what you'll actually see when you'll have to actually do the conversion on your midterm exam. This is a little bit more complicated than the homework assignment. But when I mean more complicated, what I mean is it has more categories. It's a much more complicated income statement, and it's a much more complicated balance sheet than the one we just did. Okay? But you only have an hour and 15 minutes to basically do it. Shouldn't matter because I'm also going to make your lives a little bit easier, and then I'm going to give you the labels. So to be honest with you, it doesn't matter what the categories are. You don't have to know accounting. You just have to know 1, 2, 3, or 4. Is it an asset or is it a liability? You know, on the income statement, are they making money or are they spending money? Is it taxable or not? Those are really the key items that you really need to do. In fact, I've actually thought about, and I haven't done this yet, giving you an entire midterm exam where I don't give you any titles. I just give you 1, 400, 2, 300, and just let you convert that. Right? I'm not going to do that experiment with you this semester, but I could. Because again, the labels really are what's important, but you can group them all together. But regardless, so let's go back to the statement. So one of the things that you're going to also have to differentiate that I want to talk about now, because it's on your homework assignment and it will help you with your analytics, is we will differentiate in this class between operating cash and excess cash. So it's not just cash. And again, this is why Investopedia doesn't help you in this class, because current assets minus current liabilities is all the cash, right? But some of the cash, as we talked about previously, can't be paid out, operating cash. Some of the cash can be paid out, excess cash. So we're going to split it into those two buckets. Now, for your homework assignment in the midterm, I'm going to tell you what the operating cash is. I'm going to tell you what the excess cash is. You won't have to calculate it. It'll be listed just like it is on the spreadsheet, right? But here's the point. How does operating cash and excess cash actually affect free cash flow? Right? Because that's something that's going to be on your homework assignment. So let's go back to the CFI statement here. This is the one from the practice midterm. The metaphor to help you understand this is checking account, savings account. Okay, so I got paid, I think it was last Friday. I took some of my paycheck and I sent it to Fidelity because I'm going to use that money to then invest it in the marketplace. Okay, checking account was what I got paid in. That's where I'm going to pay my bills. Then I sent it to Fidelity. I can't do any bill pay in Fidelity. So basically, in order to pay my bills, I'd have to take the money back from Fidelity and send it back to my checking account. That's the metaphor you should think about. Excess cash is like your savings account at Fidelity. Checking account that you actually pay your bills is your operating cash. You can't pay investors. You can't give them CFI from your savings account. You can only give it from your checking account. Okay? So, CFI. This company has excess cash, change of excess cash of positive 36. If I'm moving money from checking to savings, what does that do to my CFI conceptually? It reduces the cash that I have available to pay out to my investors. If I take money from savings and I put it in a checking account, what does that do to my CFI? It makes my CFI higher because I have more cash that I can distribute. What happened here in this year for this hypothetical company? What did they do with the positive 36? Positive 36 on CFI. What does that tell you? Change in excess cash. They did what? They took cash out of their savings and they put it into checking so that more cash became available to investors. Okay, so if we go over here to our TFI, we should expect our excess cash balance to go down. So that's the point. I reduced my excess cash reserves. I used the cash to pay it out to my investors. Therefore, it gave me more CFI to pay it out, positive 36. What happened in year 2? What happens here? They did what? They put it back. They actually took cash, they sent it to their savings account, reducing the cash flow available to pay to their investors. That's what's going to be important when you have to solve for the directionality of excess cash. So, let's talk about analytics for this company. As I said, I don't have to tell you what this company is. It's a completely made up company with completely made up numbers. But you should now be able to tell me the story of this company based on their CFI. So, what happened here? What does this tell you? that they're spending more than they generated in operations, and they're probably going to have to find the money to fund that somewhere. When you throw in non-operating activities, what does this tell you? That they're buying other companies, and what money they drew down for their excess cash was relatively insignificant. Does this company need to borrow money? Yes. So I already know that this company had to borrow money. Did it borrow money? Why do I know they borrowed short and long-term debt? Because it's a negative. That negative funded that negative. So that's the point. I can see that they borrowed money. Look at year 2, 790. I now have money to pay out. What'd they do with their debt? They paid off the debt. So that's the point. I need money, I borrow money. I have cash, I pay off my debt. Right? Structurally, that's what's going to start happening with your statements. I buy back shares. Treasury stock. Buying back shares. Positive or negative? On this statement. Positive. They bought back shares. It's like a dividend. Interestingly, their treasury stock went down by 75 the following year. What does that tell you happened? They reissued the shares they previously bought back. Now, companies generally don't do that, but this is a made-up company. I was just trying to play around with the categories so you can play with it. But here's the point. Let's now look at a real company. So let's go here to PVH. As I said, Tommy Hilfiger, Calvin Klein, Primera Brands. Here's their story. Now, this is what you're going to do after the midterm, is that you're going to use real statements, convert to this real CFI. I'm going to ask you to do 5 historical years for your group project company and other example companies. And then to tell the story, I'm going to ask you to total up the years, because it's kind of like what they've done over a 5-year period of time is the total category. So I'm going to focus on the total for this simple example. But you'll see an example like this on your midterm exam. So here's the point. Gross cash flow, $2.286 billion over 5 years. Gross investment in working capital and CapEx, $2.23 billion. So basically, free cash flow before acquisitions, $63 million. 97% reinvestment rate. If you look at this company, they basically put all the cash profits they made back into the business. Kind of like Royal Caribbean. But that was before acquisitions. Acquisitions are operating in this class. Goodwill is the premium. Goodwill is operating. Here's the reason why. If I build a plant, I build the property, plant, equipment because I'm going to make products to sell to my customers. If I buy somebody else's plant and use it to sell to the customers, well, that's operating as well. I paid a premium to buy it, but it's still for operating purposes. I'm going to run that plant. I'm going to own that plant. I'm going to manage that plant. It's an operating part of my business. So acquisitions are operating investments. So free cash flow before goodwill, goodwill, $3 billion. Free cash flow after goodwill, negative $3 billion. Or 134% negative. They basically spent 134% reinvestment on 100% cash flow. So that should tell you something. Tell you what? They're going to have to go get that money from somewhere. Remember, goodwill is just the premium, because when you buy a company, you absorb all the assets, and then you use the goodwill to be the premium on what you paid above beyond that. So we're treating in this class an increase in goodwill as the purchase premium on the companies. That's the proxy we're using. But that's what you're paying for the premiums, $3 billion. Their actual spend on cash acquisitions was higher because they also bought assets. But we've absorbed the assets in our balance sheet and treated it as part of our invested capital. So really, we're just looking at the extra premiums that were paid. Now, for non-operating activities, look at their excess cash, negative 151. What does that tell you they did with their excess cash? Negative 151. Yep. Yeah, they added to their excess cash, which they didn't have to begin with because they had negative free cash flow. So they probably had to borrow some money. They also spent $2 billion on non-operating assets, right? Investments in other businesses that they didn't wholly own, etc. So when you throw that in there, they had negative $5.4 billion of cash flow available to investors. So we already know that this company had to borrow money. So look down here. Debt, negative 3570. That shouldn't surprise us. Everybody see that? Now, they also issued $750 million worth of shares, and they had this adjustment to equity that, as I said, they probably bought somebody and used their stock to buy them. So this is getting back to the accounting adjustments to get everything to balance. But basically, here's the point. Why did they have to borrow debt and issue new stock? Primarily to fund the negative free cash flow, because they made acquisitions, because every dollar of cash profit went back into the business. There was nothing left to do the acquisitions, so they needed to borrow money to fund the acquisitions. And oh, by the way, they're not buying back stock or doing a lot of dividends because there's no cash flow to do that. That's what I said, the story of the company. You don't have to know what they do, and this is already starting to be apparent about what their strategy is. Why would a company spend 137% of its cash flow? What must they believe? That they eventually are going to get a positive spread. So if you're talking to this company, they're basically investing in the future today. All right. What about, I'll show you another example of a company we looked at last semester. We looked at Coca-Cola. Actually, I'll do, the other company we looked at last semester that was interesting was Walgreens. We looked at Walgreens last semester. So here was Walgreens. We actually looked at Rite Aid, CVS, and Walgreens. Pull up Walgreens, CFI. See what we can say about this company. So, bigger company, $17 billion worth of gross cash flow. Gross investment, $6.3 billion, 37%. Didn't do a lot of the way in acquisitions, $10 billion worth of free cash flow. Almost $11 billion of free cash flow before acquisitions. 58% available to be paid out. Now, what they did do is they made a big investment in Boots. They bought 49% of Boots. They're buying the other 51% right now. So they did a minority investment in Boots. So they tied up a lot of cash, and now they're finishing the acquisition this year. And they're going to become Walgreens Boots, right? But that was this big slug of money to buy part of Boots, right? So again, that took their $10 billion of free cash flow down to $3 billion. But here's the point. Does Walgreens, because this again was a midterm exam question that a lot of people missed, does Walgreens, based on what I just told you, need to borrow money? No. Why not? Mechanically. Why do I know that they don't need to borrow money? Yes. And they have positive free cash flow, and more importantly, yeah,
Positive CFI.
they have positive CFI. So they had positive free cash flow and positive CFI. They didn't need to borrow money. So what I want to see is what they do with the $3 billion. Now here's where it gets interesting. Debt, negative 2159. What does that tell me? Sorry, yeah.
They issued more debt.
They issued more debt. So they did borrow money. Okay? This was mandatory, discretionary. You could argue it's discretionary. Now, why might they want to borrow $2 billion worth of debt? Go down. They paid out $4 billion worth of dividends and bought back $6 billion worth of shares. Did they have the cash to buy back $4 billion, did they have the cash to pay $4 billion worth of dividends? Therefore, needed to borrow the money. So here's another question. Is this sustainable? Is this dividend share repurchase strategy, this cash redistribution strategy, is this sustainable?
I have a question. Why would they do that?
Let's answer his question next, which is why would they do that? But let's talk about sustainability first. Is this sustainable? Yes or no? Why not? That's right. They're paying out more than their CFI and their free cash flow. So that they're actually paying out their free cash flow. So if they stop buying other companies and investments in other companies, it's close to sustainable because they're paying out 100% of their free cash flow. But if they keep making minority investments, it's not sustainable. So why would the banks give them the money to do this? Because the banks have to believe that this investment will pay off in the future. So that's the point. They're making a bet in a slightly different way, but similar to what PVH is doing on growth. PVH is actually going out and putting all of their money back of their profits into their own business, and then they're buying some other companies. Walgreens is not putting all of their money into their own business, but they're still buying somebody else with the rest of that money, and then they're distributing cash to the shareholders, probably because their share price has been suffering, and the shareholders wanted the dividend and share repurchase to make it look like a better company, so they wanted to do that, and the banks were willing to give them cheap financing to allow them to do this. But I'm saying if you really look at the business, why are they really borrowing money? It's to change the capital structure to increase and accelerate the rewards for benefits that haven't really been realized yet. So in a way, they're betting on the come. And you can see that story in their cash flow. So what I'm telling you is, yes, they announced a big share buyback. I'm excited that the share buyback occurred. I know that that share buyback is not a sustainable share buyback if they keep making these investments and buying other companies. Now, if this is one and done, and they could really earn $10 billion worth of cash flow on a go-forward basis, okay, then what I really know is they're going to take all the cash and they're going to redistribute it. That is more sustainable because they got $10 billion of free cash flow and about $10 billion of stock buyback and dividends. But primarily, they're making a big acquisition in the middle of this because after the buying 49% of Boots, they're now buying 51% of Boots, which means it's going to send their free cash flow way negative in 2015.